Okay, we are recording. But Nick, where are you running off to? Is this where you're buying out your lease?
No, I just got to drop it off or something.
Oh, okay, got it. I was going to say your used car is going up in value every day as inflation just rips through the economy. When used cars go up in value,
there's a real problem.
Oh yeah.
When a depreciating asset starts going up, like when it just kind of changes.
Yeah.
Oh yeah.
Sorry, and I should let everyone know, I'm sure they know from the intro, but Fabio Campanella from the Campanella Group is here with us. And isn't that weird that used cars are going up in value?
Are they still? I think it changed.
I don't know. Maybe it's calmed down.
But every time I see a chip shortage headline, I'm like, oh, great, jackpot. Like it makes me happy.
So
because I have a new car coming, I still have the used car. I'm like, oh, this just works out for me.
Exactly.
So some of the guys that Aiden lives with in London by Western, they camped out in front of a Best Buy. He was mentioning because I guess there were some ASIC chips going. They knew.
Oh, wait,
the
he's in
miners.
university.
Yeah.
Holy
second year. Yeah.
Yeah.
Sorry.
Yeah. No, you can swear.
I want to keep it clean.
Swearing is
Your hair's
allowed.
I'm allowed? Okay.
Your hair on the side's too short. I can see the gray in the beard. So yeah, he's officially old.
Holy.
Yeah, he's second year university, right?
Oh my God.
Yeah.
Dude, we're the
We're
old guys
so
now.
old.
You're not old.
I'm old.
How
man.
old are
I'm
you?
44.
Oh, you're
I
older
told
than-
you this last time.
You're older than me. Oh,
Yeah,
I'm
man.
gonna see a young spring chicken here.
I'm old.
Mike and him used to work at
Dave and
Buster's off 400 and Highway 7. Remember that, Dave and Buster's?
I thought that only opened a few years ago. I don't even realize how long that thing's been around.
Decades ago, not years
Really?
ago. Decades.
When that place
ago.
opened.
Yeah, I was like all excited to go. I remember when that place opened.
Yeah, we did like software sales events at that thing.
We
Then
did
we did Rockstar
stuff there too. Yeah.
But Mike and I think you guys used to work together there, maybe?
We used to work together. We knew each other there. Then I knew him through the club industry.
That's right. Yeah.
We had mutual friends. I've known him for decades.
You mentioned.
Decades. Yeah.
So funny that you guys cross paths there. And now Mike is working with, I don't know how many millions of dollars in real estate.
Dude.
Fabio's managing millions of dollars. How many millions of dollars of people's lives?
What's the world come
I mean,
to?
if you knew us
everyone.
back then,
Yeah,
you would
these
not
guys-
give me a penny.
Yes, heads up, everyone. These guys came from Dave and Buster's.
Yeah, literally, Dave and Buster's bar, serving
We were
alcohol.
behind the bar at Dave and Buster's. Now we are managing portfolios of hundreds of millions of dollars.
Jesus.
What a life. What a life. But anyway, we're going to try and pull off the impossible here because we're going to talk about life insurance. And
we're doing a PowerPoint presentation.
Yeah, we're doing a PowerPoint
via podcast.
Yeah, via podcast. But so strap in, everyone. But for whatever reason, I like to think I can catch on to subjects rather quickly. Whenever we get into insurance and taxes, I don't know what it is. I just start losing it. So we'll see if we can break this down rather simply. But the idea here started with what insurance should people buy? How do they get ready for estate planning? And then you said there's a whole shitload of stuff they should consider. And I think you've mapped out a little bit of a scenario to kind of walk us through.
Right. So what I'm going to try to do, for those people who don't know me, I've been on the show a couple times. I'm a financial planner, accountant, tax specialist. What we're going to concentrate on today is financial estate planning. Okay. So I'll give you a scenario. All right. A lot of your clients are now amassing, and I know this for a fact.
We're going to say now old.
Yeah.
Yeah. Sorry.
Yes. For lack of a better term, they're getting older. And we have many, many, many mutual clients. And I've helped a lot of your clients over the years, and you've helped a lot of my clients over the years. And what's happened is, people are starting to push into their 30s, 40s, 50s, 60s, and even beyond your clients and the listeners of your podcast. What they've done is they've done everything right in life. They've been good with their money, and they've made smart investments. Particularly, they've made, which in my opinion, overall, one of the best investments is real estate. But there comes a time where, you're kind of done buying more properties. It's inevitable, and you're sort of managing what you have. All right. So the scenario that we're going to go over here is I've tried my best to water it down as much as possible. Okay, so it's based on an actual client scenario. I've cut out everything that's unnecessary and I've watered it down. All right. But the scenario we're going over here, let's call it the Smiths because I'm such a creative person. All right. So we got the Smiths. All right. essentially what you have is a middle-aged couple who have amassed some decent wealth. They don't see themselves as wealthy or rich, but when you look at it, they are one percenters. All right. And a lot of the people listening to this podcast may not think of them as one percenters, but they are one percenters.
So what does that mean? Like, is that if you,
in your mind?
Yeah, to you, it's you own what, a handful of 3, 4, 5 properties. Right. You have some RSPs of, over time. You've have I don't know.
If you're like in your 40s, you could easily Google this, right? But if you're in your 40s and being in the 1%, I look at it decade by decade, right? Because if you look at it overall, okay, the 1% in Canada makes $250,000 a year, and that's the definition of 1% by revenue. But that's not necessarily where you are if you're in your 20s, right? Now you're in the 0.01%, right? But if you're in your 50s, probably, and somebody's going to fact check this and whatever.
That's
but
fine.
The comment on
we're
Twitter.
wrong. Hey,
Probably,
we're wrong a lot. We're wrong a lot. It's okay.
You own your house in Toronto. You have maxed out RSPs, RPPs, which is very normal in your 50s. You have 3 or 4 rental properties. And maybe a stock portfolio or some Bitcoin.
Yeah,
you're up there. You're up there. You're in the top 5%.
So you have a variety of assets. You've paid off your house, and
you're in a really good position.
And you still have strong income coming in.
Usually, these people
still
anecdotally, from what I've seen, dealing with hundreds, maybe thousands, probably thousands of clients, they do. They always have an income coming in.
Still coming in. Okay.
Yeah. Very few people who have the means to retire at 50 actually retire at 50. Okay. So in this particular situation, you have the Smiths, age 50. Let's just make them nice and even. Okay. They work high powered T4 jobs, let's call it. Upper middle management. Okay. 3 children, 22, 20, 18. And this is the key. They are all interested in real estate. Okay. If they're not interested in real estate, everything that comes after this, the kids are worthless. Unless
the kids are worthless.
No, sorry.
What we're about to share is useless.
I know.
It's got to be that the kids are interested in real estate, okay? Unless we're dealing with ultra high net worth families where we don't care what the kids are interested in, we're setting up a trust.
Got it.
Okay? So this is kind of like a normal-ish family, all right? The kids are interested in real estate. They've accumulated, wealth over time by making smart investments and being prudent with their money, being good with their money, okay? They want to pass their properties to their children after they pass away, because I think all 3 of us are in agreement. You got a good property, it's cash flowing, you can maintain it. Why on earth would you sell it?
Don't sell assets, yes.
Why on earth would you sell it? And, this thing now, as you get older, you start thinking about intergenerational wealth, right? So, their financial plan, by the time I was looking at their estate plan, their financial plan, their retirement plan, they're secure. They're good. Okay. Bunch of RSPs, TFSAs. They already had a sizable tax portfolio. They already have term life insurance. They already have disability insurance, and they're good. They're good. Okay. So what is the issue? Okay, I'm not going to get into the small, minute details of the legal issues of passing properties on and, hey, we can avoid probate by putting this person in that person's name or an estate freeze, whatever it is. Okay, that's way too complicated for this. The issue, though, is the thing that people don't think about. Wait a second. When I die, am I going to have to pay tax? What do you think the answer is?
Yes.
Of course.
Welcome to Canada. Welcome to the world.
So a little bit of basics of estate taxation. We don't have a direct estate tax in Canada. In the States they do. They also have a gift tax. We don't have this, all right? The only thing that we have that's similar to an direct estate tax would be a provincial type of tax. We call it probate, right, here in Ontario, or at least that's what we used to call it. And, that's 1.5% of the value, the fair market value of the estate that is on your will that passes through probate, passes through the courts, okay? What we do have, though, is we have a mechanism within the Income Tax Act that deems the deceased to have disposed of all their assets at fair market value the moment before they die, okay? Now, when you think of that,
You
we all
get
hate
pissed off.
I always, you get pissed off. I don't, because I make money by helping people avoid this, right?
Works for you.
Yeah, for me, it
Negative
works
for us.
fantastic, right?
Yeah.
But the idea here is the policy. Whenever you have these tax rules, you should always go to what the policy is. And the policy of the government is, hey, that's great that you've accumulated wealth. Congratulations, you've enjoyed it during your lifetime, right? But it's not fair to have wealth simply accumulate, have all these pregnant gains, capital gains, and you never pay tax generation after generation after generation. That's what that used to happen way back in the day. And then what happens is you have people that were basically servants and then the landlords.
Maybe like a feudal system, yeah.
Yeah, exactly. So they're saying, listen, at some point, we got to trigger tax.
We're going to redistribute. Here's how we're doing it.
Yeah, you have to pay the piper at some point, okay? So the deemed disposition of your assets at death, especially if you've accumulated assets for which there isn't an annual tax, like let's say a GIC or a bond, right? Which I don't think any of your listeners are really interested in buying.
No. Hopefully not. No. If you're listening to this, please don't.
Other than that, like a piece of real estate or a stock, like a stock of a bank or something like that, accumulates in value. And until you actually sell it or it is deemed to be disposed of, there's no taxable event, right? So the deemed disposition deems that you've disposed of your property at fair market value minus the adjusted cost base, aka what you bought it for, the difference being the capital gain. Under current legislation, half of that goes to your taxable income and you pay tax at your marginal rate. There you go. When I calculate this for people, okay, it actually blows their mind how much tax they're projected to pay.
Well, yeah, because I'm looking at the next sheet and I'm like, what the hell?
Yeah. Okay. Well, are you going to map out an example here?
Yeah. So, I mean, there's a bunch of words there for people to read. Who cares, right? So in this particular,
skip the words.
Yeah, skip the words.
Skip the words. Let's go to the numbers.
Right. Let's go to the numbers. In this particular case, right, we have things that they want to pass on the client. Okay, nobody wants to inherit a stock portfolio. Nobody cares about that. Okay, nobody wants to inherit certain types of assets. What people want to inherit are high quality, difficult to get, revenue generating assets. Okay. And
why do you say that? Because a lot of people would be happy to invest in a stock portfolio. Or you're just seeing,
but nobody cares. I'd rather if somebody.
But you don't care because they're just
I'm
going to
give you
$1
million of stocks or $1 million of cash. What do you want?
Yeah, I take the cash first.
Because you can buy stocks if you want, and you could buy real estate if you want, and you could buy other things if you want.
You just skip the step of having to sell it, and you don't know what stocks.
Exactly.
Yeah.
Right. But rental properties, people want those because it's like, hey, I've got these rental properties. There's already high quality tenants in it.
Even the next generation.
That's what I'm saying. And you've seen that from the client. Okay, so
I've seen this a million times.
Yeah, and at the
really?
beginning, it's the kids who are interested in real estate. So then obviously it's
Right.
And I hear one of them is a family cottage.
Then
and
there's
then
the
for sure,
emotional
there's
attachment, the family cottage.
Sure. Yeah.
Right.
The memories.
People want that. People like siblings completely scrap over it. Mm-hmm. Okay. And that's a whole other life insurance issue to be dealt with that we're not really going to cover here. Okay. So when you take this particular family, they've got 5 rental properties, right? I put them all at $800,000 because let's say $800,000 is about a single family home in, I don't know, Hamilton kind of area.
Sure.
Right. Bungalow. Right. I don't know. Maybe I haven't been paying attention for the last 2 months, so it might be $1 million.
So
I don't know.
today's fair market value you're saying is $800,000. Sure, that's
They were, and then in this example, you have them purchased for between $450 and $650, depending on the $750.
Yeah, they accumulated the assets over a 5-year period.
Yeah, and in your example, you have 5 rental properties and 1 family cottage. So a total of 6 properties, all purchased between $450,000 and $750,000. Today's market value of all of them, you're basically saying $800,000. The family cottage, $950,000.
You got it. Okay, that's today.
Yeah, this
is the scary part.
This next column is where it gets interesting.
Is the scary part.
What I've done, what I usually do. And it's so hard to predict. There's really very little guidance on it. But when I do my projections for property, in the GTA, which is 90% of my clients, that's what they primarily have. Okay. I compound a return of 4% a year. It's probably going to be higher than that. All right. But if you compound a 4% return on investment on these particular properties, and remember, the beautiful thing about real estate is whether there's mortgages on this or not, you're compounding on the fair market value, not on the net of the mortgage. Okay. When I compound at 4%, these properties are going to be worth about, 3.8 million to 4.5 million each
by the age of 90.
So the 800, just for people listening, so the 800,000 fair market value, this couple's 50. So you're compounding at 4% over 40 years. So if the couple lives till 90, then based on that rate, then each one's all worth 3.84 and the cottage is worth 4.5.
And that's at 4%. You realize at like 6%, this number is completely blown out of the water.
Completely blown out of the water. It's not even.
We're not even in the same reality here.
At 6%, I'm gonna, just to let you know, at 6%, I'm gonna have trouble getting these guys insurance
because it's such
to
a
cover
big number,
that, right? Which is fine because there's always the component of we could do an estate freeze in their 70s, right? Which is a topic for another podcast. We could.
Fab's just inviting himself back.
Yeah, I know. I see that. Yeah. It's already booked in the calendar.
It's already booked. Yeah. We could do an estate freeze. There's other techniques. It doesn't all have to be covered with insurance, right? But when you come down the calculation, and I'm sure that if people are really interested, they can download this, right?
Sure, and I'm sure that we'll give out your contacts. We'll be able to find it.
Yeah. We're looking at under current tax legislation, if they get capital gains treatment, which under current tax legislation, this scenario would get capital gains, okay? They would be owing about $5.3 million in tax.
And I just want to walk everyone through that because 50% of the whole portfolio would be the total projected taxable capital gain at 50% is $9.4 million.
That's half the gain.
Because that's half the gain.
Because what no one thinks about when you buy the property is if you go 40 years from now and each one of these is worth 3.8, the capital gain on each of the rental properties in this example is $3 million.
Yes.
So then when you add that up at the end of life,
it's a big number.
Yeah. At the end of life, all of a sudden, so if you hold these things really long term, then there's a big tax amount owing because I've never thought about this stuff.
Yeah.
With I have some properties that I bought 20 years ago already.
Yes.
And just the growth in that, I'm like, oh, wow.
So this portfolio really has a gain of $18 million is what we're saying.
Yeah.
Right. And they owe tax against $9.4 million at a tax rate of 53%. That's working out. That's
today's rate, so that'll go to 93.
But let's stick with 53. Then, Fab, that's what you're saying. The total projected taxes at the second death, so I guess it's the last to die. That's how this works out of the couple.
Yes.
Assuming they own them together, is $5.392 million.
Under current legislation.
So
there are a lot of rumors that the capital gains inclusion rate may go up.
Yeah, we can all see it coming.
No, minority government, it's not going up yet.
Yeah.
So but in our lifetime,
but sooner,
it's going up.
If it goes up to 75%, which is possible, then we're looking at taxes at second death of just shy of $8 million.
I didn't realize this episode was going to be a horror show, Fab.
Yes, it's sort
It
of.
doesn't matter. You know what?
No, I know.
I'll let my family deal with it, man. I'm gone. I'm gone.
So now that's...
Hey, we did pretty good. Good luck.
Yeah.
I'm at the gates of heaven with God, baby.
You stick a video at your funeral and you just play it. Hey, I would just like to let you in on a little secret. You owe some taxes on my estate, and everyone here is fucked.
Well, generally speaking, that's what happens.
Yeah, oh, really?
Yeah.
They play a video at the funeral?
They play a video, and, it's all...
laughing.
It's laughing. And
CRA's
everyone's high-fiving each other.
Yeah. And I've called CRA. They're walking in the back of the room right now.
Yeah, they're with their like a church. They have the basket ready for the money, right?
We take Visa, MasterCard.
Blood, whatever you want. Your firstborn son, right? So... ultimately, that's the tax owing. When someone with this kind of wealth passes away, obviously it's not just the assets that they want to leave. They're going to have cash. They're going to have stocks. They're going to have, but usually people don't have a house left because they move into long-term care. There's going to be something left. We projected about $2 million left. Okay. So if there was $2 million left, they're obviously going to use that to pay the tax. There's going to be $3.4 to $5.9 million of tax payable. The question comes, right? The first question is, how are you going to pay that? That's
Jeez.
number one. The second question is, there's 3 kids. What if 2 of them don't want the family cottage, 1 wants it? How do we equalize the estate? That we're not, well, if we have time, we'll cover that.
What a complete
Okay.
mess.
It's a
Yeah.
complete mess.
Holy
And it
smokes.
takes a long time to get this
Sure, I can
going.
see
If everyone gets along, there's a simple answer, I guess, is that you just offload one of the properties, it pays for the majority of it, and then you're covered. Like, does that ever? We see that must
I've
happen
s-
sometimes
It happens all the time.
But then if you have if there's 5, 6 kids or total
Yeah.
siblings
Well, I
involved,
want this one.
grandchildren,
I don't want to sell it.
don't
then
want to
it's-
sell.
it's
Everybody
a
needs to
disaster.
get one.
then
We're not selling ours.
What
you sell
most often
yours.
happens is there's an odd number of kids and even number of properties. There's properties that one kid wants more than the other, the family cottage. It's like, I only want to go once a year. I want to live there 3 months of the year, blah, 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 whatever it is. So you need to take care of, this is the other part of estate planning, which is will planning and speaking with your beneficiaries. We're not going to cover that. But in a situation like this, you have a couple different choices. All right. You can sell a property, but once again, the kids
maybe you don't
don't
want
want
to.
to sell a property.
Yeah, they're interested in real estate, and it's a good asset. You don't
It's
want to
a
give it
good
up.
asset.
That'd be a bad market. Maybe
Yeah.
it takes forever to sell.
Exactly.
I'd
And you
even
lose
be-
money. You
Plus,
lose money.
personally, I'd be happier if they kept it.
Yeah.
I'd be like, good for them. They kept the asset.
Yeah.
Smart move. You know.
You could sell the asset. You could refinance the asset. It's not as easy as people think, because people have to put personal guarantees, and one person doesn't have good credit, the other person has credit, creates fighting, blah, blah, blah. The other solution is you can finance the tax bill in some form right now. Okay? So in this particular case, what we have is, we devised a strategy, and this is a really watered down version of what actually.
Sure. But I think it's going to paint a nice picture for everyone.
So in this particular case, what we used is a permanent whole life policy. So for the listeners who have very rudimentary knowledge of insurance, life insurance, or zero knowledge of life insurance, I'll give them the way that I explained it to my 9-year-old. Okay.
Thanks for thinking so highly of our audience there. But
No
we
problem.
appreciate it. But actually, I want that explanation for
All right.
myself. So keep going.
So what is life insurance? Life insurance is simply an insurance at its core. There is an insurable interest in an asset or a risk. And in the case of life insurance, the asset or the risk is your risk of dying. Okay. And there is a 100% chance that you are going to achieve that risk of dying. We just don't know when. Okay. So what you do is you say, okay, look, how are we going to cover this risk? You can self-insure by saving your own money, right? Not the best strategy. Or you can pool your money together with a bunch of other people, then have these smart people called actuaries calculate the risk of this, how many people in this pool are going to die every single year. Let the insurance company invest for the spread between when you pay the premium and when you collect on the premium when you die. And then you're going to have a higher chance of getting the amount you want without having to save a lot at the beginning.
You're getting a lower. You're basically getting, for a lower cost, you're getting what you need.
Right. And you're covering the risk of dying early. Okay. So what we did here was we purchased a participating whole life policy, which differs from the life insurance that most people know. Okay. So there's 2 types of life insurance. All right. Broadly speaking, there's going to be term life and there's going to be permanent life. Term life, think of it as an auto lease. You are leasing that auto, you're paying a monthly payment, and as long as you make that monthly payment, you are free to drive that car, but you don't own it. You got to give it back at the end of the term, or you got to renew the lease. Okay? Permanent life insurance policy is, I'm going to buy the car. You buy the car, it's yours. You can theoretically drive it forever if it lasts forever. It's your asset. Okay? So that's the same between term life insurance and permanent life insurance. Term life insurance is something that is used to cover the risk of dying early and leaving beneficiaries in a bad position financially. Permanent life insurance is something that is originally was used specifically to cover a cost that you knew was going to arise at death. What do we have here? We have a cost that we know is going to arise at death, at the second death, which is tax. Okay? So what we did was we got into this particular policy, and what we did it as a joint life policy, meaning that there were two individuals insured under one policy.
So you get a better rate that way?
Yes.
If it's joint last to die?
If it's joint last to die, statistically speaking, you get a better rate. You get a rate of a younger person. In this case, they got the rate of a 43-year-old rather than 50-year-old.
Okay.
Because what's the actual chance of both of them dying at the same time, or
Got
both
it.
of them dying early? It's much lower. It's the equivalent risk of a 43-year-old individual dying.
Got it.
Okay, so we dropped the rate by doing a joint last to die policy. It was a permanent participating life insurance policy, and I'll get to that, what that is in a bit, so that we know we're going to get it as long as they make their premium payments. Okay. Then what we had to do, like, this is an expensive policy. This policy was $50,000 a year. Okay. And
Jesus, Fab.
we,
Can you get them a VIP discount or what?
no,
No, that's
I did. That's because I got them the 43-year-old.
43. Okay, you structured it. Yeah. That was the VIP discount. Okay.
Right.
Okay.
So in this particular, well, I mean, it's expensive, but for this type of planning, it's actually not
And
expensive.
this type of family can afford that amount.
Well, yeah, I'm going to show you the technique that we used.
Oh,
right?
sorry. We haven't even got to the juicy part yet.
Yeah, we haven't got to the juicy part. Okay. So they have something to do with that $50,000, right? They still like stocks. This particular family still likes stocks, right? So they're like, okay, but they still wanted a stock portfolio. So they had something to do with that. They didn't want to just pop it into the life insurance policy and just let it go.
Sure.
Okay. So what we did is, rather than funding the policy through cash savings alone, okay, we devised a strategy whereby we utilize the cash surrender value as collateral for an annual loan, like an accreting annual loan that increases every single year based on the increase in the cash surrender value. And I'll explain all of this,
Sure.
how it works. And this allowed them to reinvest the annual premium back into their stock portfolio. Okay. So they had the life insurance coming, and they had the stock portfolio continuing to grow.
Because they were using the life insurance as collateral.
Correct.
For a new loan.
Yes.
And the bank was okay. Whoever's funding that loan is okay with it, because if they don't pay, they're the beneficiaries on that life insurance policy. They know they're going to get their loan repaid through that policy.
Right.
But the advantage to the couple is they're getting access to money that they would have just paid for in these life insurance premiums, and it was gone.
Yep.
But instead of that, through this, they're getting it back to them so they can use the money today and have the life insurance policy.
Yes. So the life insurance policy, the whole life policy, you can think of it almost as really, there are hybrid policies, universal life policies. I don't really deal with them because I'm more tax planning, more so than pure speculative investing. But a whole life policy has the death benefit component, and it has the cash component. Under current legislation, I believe you can go at a certain point, something like 80-90% of the premium can go to the cash value of the policy. All right. It used to be way better than that, but then I think it was 2017 is when they changed the legislation because it was way too good. Right. So what happens is you pay 50 grand in, and when you look at the schedule that I have, a component disappears, and you're never going to get that back until you die. Okay. But then another component goes to the cash value. That's an actual portfolio run that you partially own, run by the insurance company's management board. Okay. And you actually own that money. You own that cash value. It's yours. You can post it as collateral for a loan. You can cash it out. What
would be the difference between posting that portion as a loan versus cashing it out? Isn't that exactly the same thing?
No, it's actually quite different.
Okay.
So when you think of it like this, I have money in the bank.
Okay.
All right. And this money in the bank is paying a dividend of 6% a year. Okay. Which in the policy that we got them, that's the current dividend, 6% a year. Okay. And cashing it out means cash it out, and I don't get that 6%.
You're losing the asset. Yeah, got it.
But I can go and
borrow
against it and pay.
Okay.
In their particular case, they were able to achieve prime plus 100 basis points, right? So prime plus 1%, 3.45% right now,
Yes.
about. Okay. So the spread is beneficial to them. Borrow against it. Okay. So you're building up the cash surrender value, you're borrowing against it, and it's automatically, in the way that we did it is we have a product, there was a product available whereby if you're securing against a CSV, a cash surrender value CSV of a life insurance
I thought
policy.
of an Excel spreadsheet when he said that. If you're securing it against an Excel spreadsheet. Sorry, go ahead.
Yeah, the minimal underwriting, a credit check, and I don't know, a couple signed papers, and they'll give you 75%.
Okay.
Okay.
Are you talking in past tense when you say that product?
No, it's still
exists?
available.
Okay.
Yeah. If you want to go up to 90% or more, if you want to go up to 90%, generally we take you to the private banking divisions of, let's say, like TD or RBC or something like that, because it's more underwriting. You've got to give financial statements and annual tax returns and whatnot.
Okay, so then in this illustration, to give some actual numbers to people so they have an understanding, is you were taking the $50,000 premium, which in most of these things is in most of these illustrations is kind of over 20 years, right? So it's 50.
Yeah.
But we'll look at the first 4 or 5. Let's say 5 years. So it's $50,000 over every 5 years. First year that the loan that you can borrow against is pretty negligible because because of the percentages.
This particular loan product will not kick in until year 2.
Okay, perfect.
Okay.
So that's why there's a zero here. So then after the second year, you've contributed $100,000, but then taking out a $40,000 loan.
Correct.
After the third year, you're 120 in. You've taken out 80. After the fourth year, you're 160 in. You've taken out 120.
Yep.
And 5 years in, you've contributed $250,000, but your your loan that you've taken back out is 160.
Correct.
So
Yeah.
so.
And that goes into a stock portfolio.
And then you use that to
Invest.
offset. Yeah.
Okay.
Because the interest rate on the loan is in this example you were saying was about 3.5%. So anything above and beyond that is then you're getting kind of the best of both worlds. You got your insurance.
Yeah.
You're getting the death benefit, which is a separate thing altogether. The loan doesn't impact that.
Correct. Right. So now what I'll read out the assumptions. All right. It's so mom and dad, age 50, non-smokers, good health, joint last to die policy. It's a premium option is 20 pay. But you could do a 10 pay. There's also products that allow you to do an 8 pay. And there's the product that I use most is a life pay.
How did those all work? So if I do, is it the same amount spread over 10 payments or 8 payments? Like, so in this example, it's $50,000 a year over 20 years. So that's $1 million. If you spread it, does it just change 10 payments of $100,000? That's the way it changes?
It would be it would achieve something similar.
Okay.
But it depends on what is needed. So like say a 10 pay or like there's another product I can't remember which insurer offers it. It's like eight years. The 10 pay or whatever, those types of premiums, I utilize those more for, okay, we have this pot of cash that we are never going to use. What do we do with it?
Okay,
I want to accelerate.
Stuff it into this policy.
Exactly. I want to accelerate the payment into the policy as fast as possible. That's not the case here. They have excess cash coming in. They after they max out on their RSPs and this, that, and the other, and they're like, what do I do with this remaining $200,000 a year? Like, you know what I mean? So in
Does
this
buy any
particular,
Bitcoin? Tom, did you tell these guys to buy Bitcoin?
Well, that's what
first thing
they're
going through my
gonna
head.
do.
Okay. Yeah, first thing going through my head. I'm like,
So-
I get to borrow out. I'll buy Bitcoin.
Yeah. So now the thing here is they do like that kind of stuff. Bitcoin, stocks, this, that. They like playing with the money. They do their own. They do their own
buying
trading.
Bitcoin is not playing. Okay.
You know.
I'm joking. Keep going.
So, but what they do want is they want to have a predictable end game. Okay. And the beautiful thing about this, so once again, we predicted that they're going to die at 90. We're going to, because of the way we structured it, they're actually going to be able to deduct the interest on the loan, and they're going to be able to deduct the NCPI, the net cost of pure insurance, which is going to be a calculation because the insurance is used as security against a loan. Okay. So it's actually quite tax efficient like that. All right. The other tax efficiency is that you see the cash surrender value column. All right. That's currently paying 6%. All right. And it's very steady, right? Next year it might pay 5.5. The year after that, it might be 6.5, whatever. It kind of goes with rates, right? That's paying 6%. Because we set it to paid up premiums, that 6% comes and they're not cashing it. It goes to buy more life insurance, tax-free. So they're not paying tax on that 6%.
Awesome.
They're writing off the 3.45% per year. They're writing off the net cost of pure insurance every single year. Okay. And the death benefit comes tax-free. Okay. So they're kind of like, for lack of a better term, sucking and blowing. Right.
So the difference, very technical term.
Very
there,
technical.
But okay, you can talk about this because I want to take a little bit of a
So
side.
just the difference between anyone listening when they hear, this whole policy, if you sum it up, the total loan balance that they'd be able to take over the whole policy adds up to like $1.2 million. The death benefit is $4.6 million. The total cash surrender value is 3.8. So what's the difference between the total cash surrender value of 3.8 and the death benefit of 4.6? Like, why are those two different numbers?
The death benefit and the cash value?
Yes.
Okay. The reason being is eventually they kind of catch up to each other, right? But if you look here at the beginning, right, there's a death benefit component at the beginning. So start at the beginning.
Yep.
Okay. You have $31,000 of cash value in year one, $1.3 million of death benefit. Okay. The death benefit, I want you to extract the two from each
So you
other.
have that death benefit from day one.
From day one, you've got that death. If they die in a car accident, they are immediately getting 1.36 million.
Got it.
Okay. Then eventually what happens is the CSV grows and grows and grows and grows and grows and starts catching up over time. So the death benefit, the ROI on the death benefit drops. The ROI on the CSV increases.
I guess where
over
I'm
time.
confused, and Nick, I shouldn't be confused on this because I think we have a policy like this, but it just shows you where I'm at. If it's a last to die policy and both people pass away, the estate is getting 4.6 million on the death benefit. Let's assume there was no loan or anything like that's what they're getting, correct?
No,
they're getting the cash value.
They're getting the death benefit minus the loan.
Sorry, but I'm saying assuming there's no loan.
Oh yeah.
Yeah, assuming there's no loan, they're getting the full.
But you see the death benefit grows because the CSV grows.
Yeah,
and you're buying, and the dividends are buying more insurance.
How do I take advantage of the CSV, the cash surrender value? What does that mean to me?
You cash it in. You cancel the policy. You take the money.
You can
Okay,
cash
so
it.
that has nothing to do with the end of the death
I think
benefit.
I don't know.
Yeah.
It's not like at the end you're getting both.
You're getting both, but the death benefit, the death benefit has that as a component of it, right? So you see the death benefit here. If this was a term to 100 policy where there was no cash value, it would just be death benefit and it would be flat.
Correct.
But it accretes because you keep building up a CSV and you keep buying paid up additions.
Yeah, no, but
because
let's
the
just talk about-
CSV pays a dividend.
Yeah.
Do you get what I'm saying?
I think so. It's just at the end of this policy, I don't understand why I see the total cash surrender value or the CSV of $3.8 million.
Well, because you have that pot that belongs to you in the participating account, right?
Okay, so at the end of this thing,
And then the death benefit, think of it as the combination of that and whatever additional death benefit there is. Okay?
So that's
The
the
death
life
benefit-
insurance. That's your money from your investments plus a little bit of actual insurance.
Yeah,
from you
got
dying.
it.
Okay?
So there's no...
Is that right?
Pretty much.
Because essentially,
Yeah.
essentially, there's a check written to the estate. Correct me if I'm wrong. Is a check written to the estate, assuming there's no loan, for the death benefit number?
Exactly.
Okay.
Yeah, got it.
Exactly.
Yeah.
Now, the
But
thing that you
I
are
was just wondering if I get access to this, my estate gets access to those.
inter vivos during your life.
what?
During your life.
Yeah.
Okay?
The-
You get
Inter
access.
vivos is during your life?
Yeah, you get
Dude,
access.
he's so far beyond us.
Yeah.
I don't know how you went to Dave & Buster's and then got to what is it, what did you say?
I think that's how you pronounce it in Latin.
No, say
right?
it again. That was
inter
really good.
vivos, inter
Inter
vivos,
vivos.
I don't know.
So the
whatever.
total cash surrender value is the money you have access to
in your
within
life.
the policy while you're alive.
While you're alive. Now, there
Thank
are
you.
ways to access.
Now I'm clear.
To
So
theoretically access.
So that
the
grew up
death
to
benefit.
$3.8 million towards the end of this
Yeah.
thing.
Now you can theoretically access some of the death benefit during your lifetime if you're terminally ill.
Sure, but
and-
let's
not-
let's
that's-
not
that's-
even
that's-
go
yeah.
into that.
Well, I'm going to go there.
But this example, it's like that's the access to the cash. I have 3.8. But if it's both people are to pass away, the actual death benefit is not 3.8. The
It's
death
4.6.
benefit is 4.6
At age 9.
Now I'm very clear.
Okay.
Thank you.
So the kind of side track that I just want to take for a second is what always interests me. And it's the conversation we had when we were looking at ours as well. And now we're seeing it kind of play out. I'd be interested to go back and look at any scenarios when these types of things were in place in an environment with very, very low interest. Because right now our illustrations, and we're 5 years into ours,
Right.
and the illustrations aren't keeping up at all. Like they're way behind because the returns that the life insurance companies have been getting these past few years with their investment portfolio are far below what they were expected to be.
Well,
So-
I have every.
It's just
Give me the
ones,
other one.
It's just the ones we were given. We were given before.
No, the other illustration.
But-
from the
Oh,
other
got it,
that
got
other more complicated one.
So, but hold on. So then I'm just
No,
curious.
Fab's got the rebuttal already.
No, but I'm just
You're
curious.
done.
In
You're
a
done,
low
Nick.
interest rate environment and a high inflation, interest rate, high inflation, what and we don't have. There is no rebuttal because
Yeah,
there's no
and-
answer.
and no,
I'm
there's
just
no answer,
I'm
yeah.
just curious how this
Yeah,
looks
inflation
in
adjusted
20,
at the
30
end.
years.
Yeah,
Right.
yeah.
What you want to see here is that you guys, I'm not sure. I've never looked at your policy, so I don't know what they are. I don't know if they're universal or
Apparently,
whole life.
I've never looked at our policy either.
Yeah, I
We've
don't.
looked,
I
we
don't
just
know
what they do.
Yeah, I don't know what
It's
kind
a
of
big
policy.
booklet with a
Yeah.
lot of tables in it.
If it's a universal life policy,
Now, I'm pretty sure
those
it's
are
whole.
those are harder to predict.
We would have never got a
No,
universal.
it seemed the
Yeah.
table they gave us seemed
Was
something like
very
this.
definitive. Yes.
So let's say I don't know who sold you the product, but let's say if you look here, and I'll show this to you. These are the dividend yields historically from 2005 to 2021.
Yeah, see, this is what's interesting. So ours is with Canada Life.
Yes.
So, and what's interesting from 2005 to
drops.
2021, it's gone
Yes.
from 746 consistently dropping all the way down to 5.1 now.
Right. So you see
Does
a
it keep going
consistent drop in
Yeah.
prime.
So what on
Right.
your illustration? What yield did you use?
In this one, I believe we used Sun Life.
Oh, okay.
Okay. Current 2020. it was
Because that's what's
6%.
interesting. Because if that
Yeah.
keeps falling during the thing, and I guess at the end of the day, like it will make an impact. Because especially compounded, like if we, the total cash flow gets all the way up to,
Right.
or the
It's the compounding that kind of saves you.
it
Well,
saves
that
you,
and
but
it's also
it'll make a big difference. That 1% difference in yield compounded over all those years
Yes,
also makes
sure.
a big difference.
And the thing that you have to that we all have to understand is the way this is a heavily regulated industry. They can't just go and invest in whatever they want, right? They have to time fixed income type investments to a death. So they're kind of buying and holding to maturity. Do you get what I'm saying?
Yeah.
That's why you get a
Can you
smooth.
imagine being in their shoes right now?
Right now, 'cause
No,
with
but
the
it doesn't matter.
bonds.
No, it doesn't matter.
No, I get it.
Yeah,
I
it
get
doesn't
it.
matter because if you hold to maturity, you get the return that you set out to get.
Yeah, but if they're buying bonds right now, the return is negative
The return is negative on what do you call it?
on short term.
On short term. But if you're buying to maturity, they're planning.
Yeah, they're
They're
thinking
planning
that
ahead. But they're not just buying bonds.
Sure.
Okay?
No,
they're also
no.
doing infrastructure loans, which are going to be at, hey, we're going to do this 30-year infrastructure loan to a government, and it's going to be on a floating rate of prime plus 3.
Yeah, got it.
So okay, prime goes up,
So it
and
offsets it a
that
bit.
drops bond prices. They have essentially a floating rate.
Can you believe
rate
the
bond,
mathematicians
right?
that work in these places?
But they also have real
What a
estate.
horrible-
You know that these guys have real estate.
Sure. Yeah,
They
I
have-
know. They're all heavily weighted on real estate.
Heavily weighted in real
Yes.
estate. They
Yeah.
also have stocks.
Yeah.
And the beautiful thing about the way that they're allowed to credit the accounts and the reason it's smooth is they have this institutional smoothing. So let's say stocks do 20% in a year,
Mm-hmm.
and they have a really good year. They can say, okay, like, all right, we did really well this year. We're going to bank some of that and save it for later, and we're only going to credit the dividend 6% this year.
Oh, got it. Okay.
So that they
That's
make it
super helpful.
Oh, really? I didn't
Yeah.
know they did
Yeah.
that.
so
Yeah,
they
that's
make it
interesting.
smooth, and this is why.
So if they kill it on Tesla,
Yeah.
they can just
They can
park
bank
some of
it,
those
and when
gains.
they suck
Yeah.
another year, they can
Yeah.
put,
Exactly.
They can put it back in.
And what that does is it gives us what we're trying to achieve. We're not looking for a 6% return on investment tax free to a family like this is something like a 13% return on investment pre-tax.
That's good. You're almost keeping up with the monetary growth.
You're
You're
only-
only
Yeah.
2% behind.
Yeah, you would have to go to like second and third mortgage, private
no,
mortgage.
it's
we
excellent.
get it.
It's excellent. Yeah.
You know, so it's really something. We need it predictable. So even if it drops a percent,
This serves its purpose
it
for
serves its purpose, and you're not putting all your money into this. So, anyways, ultimately, the tax play here is you're getting a policy dividend every single year, tax free. You're writing off your interest. You're writing off net cost of pure insurance. You're reinvesting in a portfolio that can be structured to be very tax efficient. Okay, you're covering your need for money at death, and the death benefit comes tax-free. Okay. This gets, and when I have an alternative balance, like a balanced, kind of like a really, 60-40, whatever portfolio on the side. So really they're investing, 50 grand in year one and then 10 grand every single year after that. If you were to do that in a balanced portfolio, you end up, it's cut off here, but you end up with an abysmal amount.
Yeah, got it. I can scroll up so you can see the number here on the screen. Oh,
Yeah.
it's probably too small.
No, like 600 grand versus the estate value that we calculate is 3.4 million. Okay.
And I guess just looking at this and having you kind of talk about being able to borrow against it, even if you don't think you can afford the 50 grand a year to do it, this couple, as long as they get through year one and they're borrowing back 40, they could almost do it on their credit line. I'm not telling anyone
you
to
could.
do.
That's a different strategy though. That's more of like a strategy we use for like a corporation.
Okay, so you've
kind
done
of
this
like,
kind of
yeah,
stuff.
for an IFA. So let's say you have because a corporate insurance is a different ballgame, way more complicated, but way more beneficial, like crazy beneficial.
See how excited he's getting right now?
Yeah.
Just go into our accounting office right now and start looking through all the files, see what you can do. Fab's going to come out of there and say, guys, I just saved you. I saved you all this money and I made you this, and here's my bill.
Yeah.
Here's my invoice.
And here's an insurance policy for $100 million.
In a corporation, you could do something called an IFA or an immediate financing arrangement or something, right? Where you like immediately start borrowing, and you could borrow theoretically. And I've seen it. You could pretty much borrow 100%.
Really? Because it's regulated differently because it's inside a corporation?
No, because the banks are more willing to give it to you. Because the way that it works is you've got a corporation with assets, and you can post the assets as collateral. It could be a piece of real estate
So they're willing to
cash in bank or whatever it is. So they're like, we're just going to loan you the whole freaking thing. And you have a need for insurance for whatever reason. It could be that, your children you have a disabled child and you need that death benefit, or that you're going to accumulate a lot of assets in your corporation and you want to pass that corporation on to the kids. So therefore, you're going to have to pay the tax somehow, right? So you have this need for insurance. Or even, hey, look, you're young, healthy right now.
It's cheap.
And it's cheap. So let's do a massive policy, 250 grand a year. Okay. And we're going to have the bank finance it for the first 5 years, 10 years, because you still need the money in operations. Then when you don't need the money in operations, you turn off the bank loan, and we can structure it such that you can do up to like about, $600,000-$700,000 a year and just shelter the money after that.
Are the people that come to you for that, because Nick and I have never been exposed to this kind of stuff because we didn't grow up maybe in a family that had a corporation that was successful enough to have these conversations. I guess, is this families who've just had a corporation through a few generations or something? Because I mean, Nick, would you ever think to come to Fab with this type of question? I would never even think to come to him with this stuff.
No, I mean, look,
now I'm thinking, geez, don't let him out of the office. Lock him in the room.
Well, I remember early some of the finance books I read, like really when I was like 20, 21. Like I remember reading just, it was just generic kind of finance stuff about different ways to make money. And I always remember reading about life insurance, but I got to be honest with you, at that time I didn't think anything of it, because you're in your 20s, you're invincible anyways at that point because you don't think about that. And I just didn't understand. Outside of the term life, I get it. I pay this much, and if I die, I get that. But this whole thing was always anything that's this.
I always looked at it as a ripoff because I'm like, the term life is cheaper. I'll make more money with the difference myself. Forget paying extra money. I'll go with the cheaper term life.
Compounded tax deferred growth is
tough to battle.
The upside there.
And we're not looking at crazy returns on investment here. Nobody's sitting here promising crazy.
No, but
it's a predictable.
Yes.
It's a predictable.
The thing is, if you can access the loan amount, that's good. But so that's the upside. You get the insurance, and we're talking about this for a very specific purpose. Remember, to cover the taxes to the estate. The only thing is, you do need the income because you do. Are you making payments while you were borrowing $40,000 every year?
Yeah, but in this particular case, you make the payment for the interest, and then you reborrow the net after-tax interest and tag it onto the loan.
So explain that to me a little bit, because you only pay once a year the interest.
Yeah. So no. So in this particular facility, I think it's I can't remember how it was structured. If it was once a year or if it was throughout
but
the year.
interest would come off.
But the interest comes off, and you can reborrow the interest. Okay. So now, if you want to reborrow the interest,
Oh, so your loan's 40 grand, but you're not getting 40 grand. You're getting 40 grand minus what the interest would be?
no, they just tag it on. So if you look at the math,
The interest comes off the,
the
total
interest comes
value
off.
of
It's
the
like,
policy.
you know,
I think.
okay.
Oh, I got you.
So in this particular situation, I can't remember because I did not work on the financial part. I was hands off on that, on the financing part. But what you can do in this particular situation is if you want to write off the interest, you have to follow the Income Tax Act's rules, right? And that states some of the rules that are very important state that the interest must be paid. You have to pay the interest. It cannot just be accrued back on. It cannot be accrued
Got it.
interest.
Okay, so
And the money must go towards something that has a potential to pay you a return on investment that is taxable.
oh, geez.
Okay, so
For
it was
someone
all
like me,
structured. You know, I don't want to get too complicated on it, but in this particular case, they are reborrowing the net after tax cost of interest, which would be whatever it is, 47%.
Okay. So just to kind of go back to our story here with this couple, they owed tax of, I think we were saying somewhere in the range of $3.392 million dollars.
Yeah.
Now they got this life insurance policy. They could, the death benefit was 4.6.
Minus the loan
minus
and the
loan.
accrued interest that we put back onto the loan.
Yeah. So the net value then is,
At the end, you go to net estate value. If they both die at age 90, 3.4. I got them to the lower end of the range. Okay. I got them to the lower end of the range. Why did I get them to the lower end of the range? I don't care to get them to the high end of the range. All right. Realistically, that's enough. If they have to pay a little bit of tax, we can refinance.
from
the
what you've
house.
seen, that's
Yeah.
okay. But in this thing, they had now the life insurance policy. They were able to borrow a bunch against it. So they were able to get some money from it and live
Yes.
and enjoy some of it.
Yes.
That was the loan component of
Correct.
it. And then afterwards, the net amount is enough to carry or to cover the estate or the probate. What are we calling it? The probate
Probate
tax.
and the probate tax and the income tax.
Sorry, the probate tax and the income tax.
Yes.
Because everything was deemed to be sold at fair market value the moment they passed away or the moment before they passed away.
Correct. Okay. Now,
Jeez.
this is where it starts to get
Fucking both
this
of
is
us
where
are
it
just-
starts getting interesting.
You need help.
Yeah.
Like you just can't do this yourself.
It actually, this is the basics, right?
Yeah.
I have-
Because
I
he
have-
keeps saying this is the basics.
I get it. The only thing, and I'm not saying this is wrong. Who I am in life up to this point is I've just realized most things that get this complicated just were bullshit. And
Yeah,
I know
yeah, yeah.
actually-
But
I
you know what?
bullshit-
When you sit down and look at it, it's actually
not that
not that
complicated.
complicated.
Yeah.
But it's taken us like
just tough to-
15
It's just there's a
times.
lot of steps. That's the thing. It's not complicated. It's not like building a power plant or something crazy intricate where there's so many different things and so many different professionals. I mean, there are quite a few professionals involved. There's actuaries, lawyers, accountants.
For me, it's always
people,
the
but-
best things in my life have always been very simple. Not
100%.
not necessarily
Yeah.
easy, not easy, but they've been simple. They've been very straightforward. It can take a bunch of work. Whereas this one, I have a policy, and I'm thinking about getting them for the kids, which I've been thinking about for a year or a year and a half.
You
or
can actually
something
do.
like that.
There's actually some the cascade strategy for the kids. I have a really good one. for
Yeah.
You're
that.
smiling again. Fab's smiling again.
Yeah, there's
never
a
seen
really
somebody
good
Let's
one.
not even go there right
Yeah.
now. We'll bring you,
You
back
could
to
actually skip 3 generations of tax with this one.
Okay, listen, Fab. In this office, you're not allowed to get excited about insurance.
Yeah.
Okay? There's rules.
Yeah.
I don't know. You
Whenever
missed
you
the
talk
rules
about
on that.
insurance, you're miserable,
Realistic.
pissed off,
Yeah, yeah.
and upset.
All right.
Okay.
Yeah.
Yeah.
But,
Well, the good thing about this one is there's actually quite a bit of flexibility in this, in the sense that, I don't think they're going to be borrowing that money, because what's going to happen is somewhere around year 10, 15, somebody's parents are going to pass away. They're going to get an inheritance. They're going to be able to over contribute to a tune of about $125,000 a year into this particular policy, shelter some additional money. Then what we can do is, instead of borrowing to invest, we can build up the CSV to a much higher level. Let's say up to almost $2 million.
This
And
is
then
the
we
cash
can
surrender value.
cash surrender value, and then we can turn on the loan to be almost like a tax-free pension
Got it. Yeah.
that comes to them.
And so they're going to live off
And
it.
right, because they're going to have their RSPs, their
beautiful,
RPP
yeah.
pensions
That's good.
that are taxable. They're still going to be in a high tax
And this is
bracket.
what you've seen with many people.
Yeah, well, for corporate clients, self-employed corporate clients, myself included, for myself, I do it. I use like a corporate IRP or an insured retirement plan or whatever the acronym stands for. But
You started whispering like that was a secret.
yeah. So
Hey guys, you know what?
Guys,
I use an.
hey, do you want to buy a policy? Right?
Now I'm starting to think I want one.
Yeah. But what you can do is you can use it as a hybrid between a retirement plan and an estate plan, where you can build up the CSV over time and you can over contribute it to build it up even faster, then borrow against it like an annuity until you pass away, clear out the loan, and the remainder goes to the kids.
It's the death benefit.
Right?
Holy smokes. Okay, so how do clients work with you, Fab? Do they just come to you? Because I'm just thinking of someone myself. Like I would come to someone like Fab and say, I'm clueless. Here's what I have going on in my life. What do you need? And let's begin. And then do you meet with them? Like you review their whole life and then you meet like once a year to do some planning or give them an overview? Like how do you work with people?
It depends.
I don't understand what
it
you do.
depends on the situation, right? You're going to come at me either from the accounting, you need accounting services, right? Or you need financial planning services.
I have a small business. I have a bunch of property. I'm a bit of a mess with taxes.
Yeah.
Fab,
and they
help
come
me
to
out.
me, and generally what I do is, I always have nobody comes into the freaking office anymore. I spent all that money on that office. Nobody
It's
comes
a beautiful
in.
office.
Yeah, and nobody
it's beautiful.
comes.
No, the pictures in there, the artwork.
It's crazy. Well, you
beautiful.
can thank John
Actually,
Paul.
you know what?
He's the design.
We actually have some
mad
white walls in
scientist
here.
there.
We'll buy those pictures off you.
Well, yeah, I mean,
20 cents on the dollar.
yeah.
Dude.
Listen, this is John Paul's baby. He's never gonna want to
Sell
sell
that?
it, right? It's such a beauty. He did
It
such
is
an
a
amazing.
beautiful- it is a
he did
beautiful office.
He blew my mind.
Yeah.
I don't know why he isn't designing
It's
for
amazing.
a living. It's
Yeah.
incredible. I kind of just, I did nothing for it. He did it all. And also Andrea played a role too. So good at design, the two of them. But regardless, nobody comes to the office. So what I generally do is I have a half-hour Google Meet with people, and it's me and depending on their situation, one of my associates comes on, takes notes, and whatever. And I see, okay, I ask them a bunch of key questions. I see what is it that they need. And I'm telling you nowadays, 1 in 3 people I'm not taking on, mainly because I'm like, hey, I think you're better suited to my friend over here. Like maybe I think John Paul would be a better match for them, or this other person.
Okay, so you know your client profile pretty well at this point. Who
Yeah,
you can help
I don't
and
want to
who
be
you
big. I want to be small. I want to be boutique, right? And it's like I can't take on everything, but I'll take the meeting. I don't care. Then there's, out of the 2 remaining, I would say I only take one of them, because one of them I'm like, I just don't want. I don't want it, right? But I do a discovery meeting and I say, okay, where can I help these people? And it generally falls into either accounting and tax planning, general, financial planning and retirement planning, or estate planning. And oftentimes it's all 3.
Got it.
Right? That's the formula that I've found works for me as a small boutique, small team, boutique specialized sort of
Yeah,
firm.
good for you. Awesome.
Right.
Holy smokes. I have no idea how you got to this level of knowledge with stuff. This is because your father was in the business, right? Was he more in the accountant?
My dad was an accountant. He was a pure CPA.
Okay.
Ran just a small practice. And my mom was a lawyer. So she worked in real estate corporate law and then switched over to family law.
Okay. So
Right?
some of this just through osmosis of the family?
Man, we would talk about this crap at dinner
Yeah, okay.
all the
Makes
time.
sense.
And I
just
didn't
because
even
the way you're talking
I didn't
about it.
realize that I learned so much from them.
Yeah, because at your age
Yeah.
too, like I know you're saying you're
Yeah.
44 or whatever, it just doesn't, you don't sound like it. Like I don't meet people like you who have this level of knowledge of this stuff.
I've been talking about this crap since I was 10.
At Dave and Buster's, he said,
Yeah.
like, I'm going to give you some tokens for the arcades.
Yeah.
And by the way, don't get a universal life, get the whole life policy. Don't go for the term life,
Yeah.
get the whole life.
So I've been really, it's been since I remember, since I was a little
Yeah,
kid.
very cool.
Right. That,
What do you, so when you see people in general
Mm-hmm.
who have this type of portfolio, is the biggest miss you feel they're making just not looking into whole life policies?
No.
What's
No,
the biggest
no,
miss
no,
people
no.
are doing?
No,
They're not
I would say
borrowing.
one. I stop a lot of people from getting policies.
Why is that?
They don't need it.
Because of
They
what?
how many people have come to me and they're like, I have this portfolio of properties, and and I look at the deck
Yeah.
produced by another insurance agent or another insurance advisor, And I'm like, yeah, there's nothing wrong in this deck.
Oh,
but
so they already have insurance.
no, they're about to buy it, and they
Oh.
come to me for a second opinion. And I say, there's nothing wrong with this deck, but Mr. and Mrs. Such and Such, have you talked to your children about inheriting the
because
properties?
of the premise of all of this.
And they
was
go
that-
back to the kids, and the kids are like, I don't want any.
So then the answer is just sell it.
Just sell it.
Yeah, sell it. Yeah. And we've seen that over
Yeah.
the years here too. We've seen it where people are just like, I have inherited some property or I have access to property and I just need you guys to offload these things.
Yeah.
Yeah, it's a good point, really, because you like if you like it, you're like, yeah, this is great. I'm going to leave these properties to my kids and stuff. But if the kids are like, I want nothing to do with
I
these,
think it's highly
then-
dependent on the discussion. Like Fab picked up a lot of this through his family discussions. I can see Aiden and Sienna are really into this already at their ages of 15 and 19 because of the way our family communicates.
Exactly.
But if you're a family, like our father never talked about money at all. So if you're in a,
couldn't.
he would hold his heart.
Yeah.
Oh,
Remember?
well, yeah, but the situation he went through, right?
Yeah, it was just intense. So if you come from a family where money's never discussed and this stuff comes up, you're probably just like, get me my cash, get me out of here.
Yeah.
Or if you're married and your spouse is like, don't touch that stuff, it gets complicated. Yeah, got it.
I think it's what it is. It's strange. It's people that come from nothing and get to what I call the mass affluent category. They talk to their kids about money a lot and whatnot. But when you get these people with old money, a lot of old
Generational,
money,
yeah.
they always use life insurance. And they don't care what the kids want because it's all going to a trust anyways.
Yeah, so they're building out the trust no matter what the
They have
kids
control
want.
after the grave anyways.
Yeah.
So it doesn't matter what the kids want.
Because in the trust, they can make the rules on how they
you
want it
got
to
it.
go.
You got it.
Wow. Fab, man, you always bring it when you come here. So thank you. I understand everyone listening to this might have been tough to follow.
Yeah.
What's the best? And I know you're not taking clients. So I don't know. Do we just leave contact information out of this? Do you want to share your contact information? What do you want
I
to
have
do?
no problem. If people want to send me an email, I'm always willing to give somebody a half hour.
Okay.
Okay.
Are you sure?
Honestly, if I just won't answer the freaking email.
Yeah. Okay.
right?
It's one or the other.
Hey, everyone listening, meet Fab, our friend.
Yeah.
He may or
I
may,
may or
not
may not.
respond to your email.
Like if you call me now, it's my I don't know how to turn the freaking voicemail off. So it's like my thing is like, hey, you've reached Fab. Just to let you know, I'm not going to check your voicemail.
Whatever
So-
happened to, remember we used to always check voicemail.
Yeah.
I know.
And then we got voice transcription services. And
I don't even
this
wanna
us-
read that.
And now it's like if someone leaves me a voicemail and I miss it, I don't even feel bad.
But
I'm like,
what-
that's
I get
your
angry.
fault for leaving me a
But
voicemail.
what's,
get
okay,
angry.
so what's worse? What's worse? If someone leaves you a voicemail saying, "Hey, Tom, can you give me a call? I want to talk to you about this," or if someone sends you a text message saying, "Hey, give me a call."
Call me. Call me
Yeah.
when you're free.
Because to me, that's the worst thing. Like I'm like, no,
Why did you make your problem my
yeah,
problem?
just
Yeah.
call me. I'm like,
Yeah,
no,
you
no.
call me, and if
there's-
you can't get a hold of me, try to call me again.
Yeah.
But I'm not going to now schedule you in
I
my
don't know what I'm
calendar.
what I'm calling you about. I don't know what you need or something.
Yeah.
Like, no.
Many times over the last
Yeah,
little
I
bit, I think just maybe our phone numbers have gotten out a little bit. I'm just like, am I going to change my phone number? Like I haven't
Yeah,
done
I
that.
think I'm
since
changing mine.
Are you?
Yeah.
Mine's easy because I don't answer anything that if they're not in my contact, I just leave
Yeah.
it.
Yeah.
So
Yeah.
So Fab, what's
Yeah.
the,
You know what? If you want to email me, if you think that
you fit into one of your buckets?
I could help you, Fabio@campanellagroup.com. Just send me an email direct.
that's easy. Campanella Group. You can figure out how to spell it.
Yeah, that's the test. If you can
That's a
figure it out.
test. If you
So
can figure out how to spell Campanella Group,
Fabio at I'm screwing up. Fabio at campanellagroup.com.
Yeah.
try to figure out how to
Okay.
spell
Yeah,
it. I
I'll
don't know.
Google. I'll Google search. If you search for Fabio Campanella, you figure it out.
Campanellagroup.com.
It'll
You're
come
going
up,
to figure
yeah.
it out. Okay. Hey, thank you for doing this. I really, really appreciate it. I know
problem.
we're on your case a little bit, and I don't know if we're going to, get that done or not to get Fabio locked up in doing some training sessions for Rockstar members and stuff. So I'm putting that in the podcast so that there's extra pressure on Fabio.
So now I got the pressure. I
Yeah,
gotta fucking develop the course.
So thank you in advance for developing that.
You know,
course.
I'll just go over
yeah,
this.
yeah. Here. Well, this pretty much is a course
This-
right
yeah,
here.
that's all you
I'll
need.
go over
Yeah,
this.
yeah.
I'll go over
So,
this.
Thanks,
in a little
man.
more detail.
You don't have to you don't have to do this. You've come in and shared a ton of good information every time. Totally appreciate this, Fab. So don't know really how to repay the favor.
Well, you know
But-
what? Honestly, guys, when I started my business, I had nothing, and you guys were so generous. Anytime you want me on, you want me to do a course, whatever you want.
Thank you.
Oh, cool.
Appreciate
Thanks,
that.
man.
Yeah,
I really
appreciate that.
appreciate what you guys
Yeah.
did for me at the beginning of my
Cool.
when I started my business.
Cool. Thank you.
Awesome.
And that was
Thanks.
totally a two-way street right from the get-go. So thank you. Awesome. Thanks, man. Talk soon.
Ciao.
Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Term show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.